Hello class, I'm very glad to be with you here again today. It is time for us to work a few problems for Chapter 13. Okay, so if you'll notice, I have a video that actually shows me. We have some wonderful new technology at Drury. It's very exciting, and I'll be working more of the problems in that technology with the clear glass. And you can see me and see what I'm writing. You can see the problem up on the board so that I can circle things. I need you out of the problem. That's probably what I miss the most of all, is I like having the problem up so I can work directly out of the narrative of the problem. Okay, so I did SE 6, Chapter 13 SE 6. I did it on the live video. So now we are going to talk about treasury stock. Okay, so I'm looking at Chapter 13, SE 7, page 529 in the Needles book. Okay, so what is treasury stock? Well, if you'll remember from your reading, treasury stock is when a company just goes out on the open market and buys its own stock back. And there are a lot of reasons why we might want to do this. We might have a lot of extra cash, but we really are not, it's not a good time to expand the business. So you can either give it back to your shareholders in dividends when you have extra cash at the end of the day or the end of the year, or perhaps you feel like there's too much stock out there because people are not recognizing how valuable the firm is. Okay? Either one of those are really good reasons to buy your own stock back. If you reduce the number of shares outstanding, then you reduce the denominator, then that makes every share be worth more. So these are mostly issues that happen because a company has publicly traded stock. Okay? Now, SE7 has us work through buying our stock back and then subsequently reselling it, which we might want to do, especially if we think it's undervalued, because we might want to buy it back, get the value up, then reissue it. Okay? So Tulip Corporation issued 16,000 shares. Okay, no, that's wrong. That's SE7. I'm wanting to do SE8. Sorry. Okay, treasury stock transactions. Prepare the journal entries necessary to record Dow Company's following stock transactions during 2014. October 1st, purchased 2,000 shares of our own $2 par value common stock for $20 per share, the current market price. Okay, well, first of all, the important thing is we don't care what the par value is. We record our treasury stock purchases at our cost for the treasury stock. Okay? So we're going to debit treasury stock. Um, 2,000 shares at $20 per share. So that means we spent $40,000 on it. Okay, and we're going to write a check for that. We're actually buying it from people, real stockholders. Okay, then, then it says on October 17th, we sold 500 shares for $25 a share. 500 shares of these shares up here. Okay, you know what? We got to start keeping track because we're going to start doing some weird stuff. All right? So we have a treasury stock account, and it is down in equity, and it has a debit balance. Okay? It is a contra account to the other equity accounts. It reduces the value of the equity showing on the balance sheet. Okay, so we sold 500 shares of treasury stock for $25 a share. So we're actually going to get cash for 500 shares at $25 a share. So 5 times 25, 125, so that's $12.5 in cash we're getting, right? We are going to credit the treasury stock account for what we paid for the stock. 500 shares at $20 a share. Okay? And how do I make this entry balance? Well, guess what? We call this additional paid-in capital treasury stock. We already had additional paid-in capital common stock when we sold our stock for more than par value. Well, we're going to call it additional paid-in capital treasury stock when we sell our treasury stock for more than we paid for it, not par value, when we sell it for more than we paid for it. Okay, so that's where that other $2,500 is going to go. So I'm going to have to set up this account. Okay, then on the 21st, it says we sold 800 shares of treasury stock purchased on October 1st for $18 per share. This time we sold it for less than we paid for it. Okay, well, don't forget, just like in the other problem, always start with the cash, because we know what people paid us. And what they paid us was 800 shares times $18 a share. And you know what? I don't know how much that is. How much is that? 4, carry the 1. It'd be 8,000 plus 6,400, 14,400. Okay, we are going to reduce the treasury stock account for exactly what we paid for it, which is 800 shares at $20 per share. So that's $16,000. Now we have to make this entry balance. Well, we reduce the additional paid-in capital account. And thankfully we have a balance in there, a credit balance in there to debit against. If we didn't, we would have to go to retained earnings. One of the few times we ever use retained earnings for anything other than paying dividends and recording net income or net loss. But see, we've got enough additional paid-in capital to absorb taking this loss. So we don't record a loss on the income statement because we sold these shares at a loss. We net it against the additional paid-in capital that we already earned when we sold the batch for more. Okay? Okay, that concludes Chapter 13, SE8. I would like to now talk about cash dividends. So we will go ahead and do SE10 on this video. Okay, turn this over a little bright. Okay, so SE10 is about declaring and paying dividends. So I'm looking at Chapter 13, SE10. SE10 says, it's not focusing very well. Leon Corporation has authorized 400,000 shares of $1 par value common stock, of which 320,000 are issued and 280,000 are outstanding. Well, the first thing I want you to notice is that the issued shares are different from the outstanding shares, and that means that they have treasury stock. We only pay dividends on outstanding stock. We do not pay dividends on issued stock. Okay, only when it's issued and outstanding. On May 15th, the Board of Directors declared a cash dividend of 20 cents per share, payable on June 15th to stockholders of record on June 1st. So we're going to make journal entries. All right, so what happens is the Board of Directors meets and they declare a dividend, and then they give a couple weeks for all the buying and the flurry of buying and selling activity to settle out, and they declare a date to be the date of record. And anybody that owns the stock on that date, which in this case is June 1st, will get the dividend when it's paid on June 15th. So when we declare it, we go ahead and put it in the dividends account at the rate they want to pay. 280,000 shares times 20 cents a share. Okay, so 2 times 28 is 56. That'd be 20% of 280, be 56,000. And we go ahead and set it up in a current liability account called dividends payable. Okay, June 1st. Is there any entry? No. That's just for our agents that help keep our stock organized to figure out who actually owns the stock right now. Okay? On the 15th, we will pay those dividends. So all we'll do is debit against the dividends payable account. We've already set it up as a payable, so now we just need to pay it. And of course, credit cash. Okay, that's all there is to it. Absolutely all there is to it. So cash dividends to common stockholders are pretty easy. We're going to do a problem, we're going to do a tougher problem with preferred stock, and then we're going to do a problem about stock dividends in the next video. Thanks.